Let me tell you about a phone call I got last spring because it's the reason I made this video. A man named Walter called me up and he was hot, furious. He just opened a letter from Medicare telling him his premiums were going up by nearly $400 a month. $400. He was 70 years old, living on a fixed income, and he could not, for the life of him, figure out what he'd done wrong. He hadn't gotten a raise. He wasn't working. His Social Security was the same as it always was. So where in the world was this bill coming from? Well, when we sat down and pulled his tax returns, the answer was right there in black and white. 2 years earlier, Walter had done something that every financial article on the internet told him was the smart move, something his own accountant gave him a thumbs up on. And that one move, a move that looked completely harmless on paper, had quietly detonated a tax bomb that was now going to follow him around for the rest of his retirement. Here's the part that'll get you. Walter didn't break a single rule. He didn't do anything reckless. He did what looked responsible. And that, my friends, is exactly how these tax bombs work. They don't go off when you make a dumb mistake. They go off when you make a move that feels smart because nobody ever told you about the tripwire hidden underneath it. I'm Calloway. For nearly 30 years, I sat on the inside of the financial world, and I watched good, careful, hardworking retirees walk straight into these traps over and over again. Not because they were careless, but because the people who were supposed to warn them stayed quiet. So today, I'm going to walk you through the 5 money moves that trigger a surprise tax bomb after 65. Some of these are going to surprise you. At least one of them is probably sitting in your plan right now. And I'm going to show you how to spot each one before it goes off. So stick with me all the way to the end, because the 5th one is the one that got Walter, and it's the most common of them all. Before we dig in, let me explain what we're actually talking about, because tax bomb isn't just a scary phrase I made up. In retirement, the danger isn't just the tax rate on your income. It's a whole web of hidden tripwires, surcharges, thresholds, and cliffs. Where crossing an invisible line by even a single dollar can cost you thousands. And the cruelest part, most of these bombs have a delay on them. You pull the pin today, and it doesn't go off until 2 years down the road when you've completely forgotten you ever touched it. Walter pulled his pin, and it blew up 24 months later. Keep that 2-year delay in the back of your mind because it's going to come up again and again. All right, let's get into it. Number 1, the big Roth conversion done at the wrong time. Now, I want to be careful here because Roth conversions are not bad. Done right, a Roth conversion is one of the smartest things a retiree can do. The idea is simple. You take money out of your traditional IRA, you pay the tax on it now, and you move it into a Roth account where it grows tax-free for the rest of your life. On paper, it's beautiful, but here's the tripwire. When you convert that money, the entire amount gets added to your income for that year, all of it. So let's say you've got a nice cushion in your traditional IRA and you decide, you know what, I'm going to convert a big chunk this year and get it over with. You convert, say, $150,000. Feels productive. Feels like you're finally getting ahead of the tax man. But watch what happens. That conversion just launched your income for the year through the roof. And 2 years later, Medicare comes knocking. See, Medicare looks at your income from 2 years back to decide what you'll pay for your premiums. It's called IRMAA, the Income-Related Monthly Adjustment Amount, and it is the single most misunderstood tripwire in all of retirement. For 2026, the moment your income crosses $109,000 as a single person or $218,000 for a married couple, your Medicare premiums start climbing, and they don't climb gently. Here's what makes IRMAA so nasty, and I want you to really hear this. It is not a gradual slope. It's a cliff. If you go $1 over that threshold, one single dollar, you don't pay a little more. You get bumped up to the whole next tier for the entire year. I've seen a retiree go $11 over a bracket and get hit with over $1,000 in extra premiums for it. $11. That's the kind of thing that keeps me up at night, because it is so easy to avoid if you just know it's there. So here's the counter move on this one. Don't convert in one giant lump. You spread it out. You do what the pros call a conversion ladder. Smaller conversions over several years, each one carefully sized to fill up your tax bracket without tipping you over that IRMAA cliff. The years between when you retire and when you turn 73, before your required withdrawals kick in, those are your golden window. Convert smart during those years, in measured amounts, and you get all the benefit without ever setting off the bomb. Which brings us to number 2, and this one is a sleeping giant that most folks don't see coming until it's too late. Required minimum distributions. Here's the deal. For your whole working life, everyone told you the same thing. Put money in your traditional IRA. Put money in your 401k. Get that tax deduction. Let it grow. And you did. You were disciplined. You built up a nice nest egg. Good for you. But here's what they conveniently left out. The government was never going to let that money sit there tax-free forever. They were just waiting. At age 73, the IRS forces you to start pulling money out of those accounts, whether you need it or not. They're called required minimum distributions, RMDs, and the word required is the key. You don't get a choice. And every dollar you're forced to withdraw counts as taxable income. Now here's where the bomb goes off. Let's say you were a good saver and you've got $1.5 million in a traditional IRA. When you hit 73, your first required withdrawal is going to be somewhere in the neighborhood of $56,000. That's on top of your Social Security, on top of any pension, on top of everything else. And all of it stacks up on your income and can send you sailing right over those tax and IRMAA thresholds we just talked about. Not for 1 year, but every single year for the rest of your life, because these withdrawals keep coming and they keep getting bigger. This is the trap of being a good saver. Nobody warns you that the very accounts you were praised for building can become a tax time bomb the second you turn 73. So what's the move? You start diffusing this one early, long before 73. Remember that golden window I mentioned between retirement and age 73? That's when you do those measured Roth conversions, drawing down your traditional accounts a little at a time while your income is low, so that by the time RMDs hit, there's less in there to force out. You're basically letting the air out of the bomb slowly over years, so it never has the pressure to explode. A little planning in your 60s can save you a small fortune in your 70s and 80s. Now, before I give you number 3, I want to step back for just a second, because this is bigger than any single one of these moves. Everything I'm showing you today shares one common thread. In retirement, every financial decision is connected. When you claim Social Security touches your taxes. When you withdraw from your IRA touches your Medicare. A home sale touches all of it. Most retirees make each of these decisions in a vacuum, one at a time, never seeing how they ripple into each other. And that's precisely how the bombs get set off. Not by one bad move, but by good moves that collide with each other, because nobody was looking at the whole board. That's the entire reason I do what I do now. I help people see the full picture before they pull any pins. Keep that in mind as we go, because number 3 is a perfect example of a good move that blows up when it collides with everything else. Number 3, selling the family home without a plan. This one breaks my heart, because it usually happens to the nicest people for the best reasons. You've lived in the same house for 30, 40 years. The kids are grown and gone. The stairs are getting harder. So you decide to sell, downsize, maybe move somewhere warmer. Totally reasonable, totally normal. But here's the tripwire nobody mentions. If your home has gone way up in value over those decades, and after 40 years, believe me, it has, you could be sitting on a massive capital gain. Now, there's a rule that lets you shield some of that gain from taxes. $250,000 if you're single, $500,000 if you're married. That sounds like plenty. But in a lot of markets today, folks who bought their home for 60 grand in 1985 are selling it for 800,000. Do the math, and a big chunk of that gain spills right over the exclusion and becomes taxable. And here's the kicker, you guessed it, that taxable gain lands on your income for the year, which means it can launch you straight over the IRMAA cliff and spike your Medicare premiums 2 years later. So you sell the house thinking you're simplifying your life, and instead you've handed yourself a surprise tax bill and a Medicare penalty on top of it. The move here is all about timing and planning. Before you list that house, you sit down and you figure out your cost basis, and that includes every improvement you ever made over the years, the new roof, the kitchen remodel, the deck, all of it, because those add to your basis and lower your taxable gain. You time the sale for a year when your other income is low. And if the gain is big enough, you talk to a professional about spreading it out. A little foresight turns a tax bomb into a smooth, simple transition. All right, number 4. And this one is sneaky because it wears a disguise. It looks like a good deed. I'm talking about withdrawing a big lump sum to help your family. Here's the scene. Your grandkid gets into college, or your daughter needs help with a down payment on a house, or a family member hits a rough patch. And you, being the generous soul you are, think, I've got money in my IRA, I'll just pull out 30 or 40,000 and help them out. It's the most natural, loving thing in the world. But that traditional IRA money has never been taxed, not $1 of it. So the second you pull out that lump sum, the entire amount lands on your income like a ton of bricks. That $40,000 act of kindness could bump you into a higher tax bracket, trigger taxes on more of your Social Security, and, say it with me now, push you over the IRMAA cliff 2 years down the road. You tried to give a gift and the tax code turned it into a bill. Now, I would never tell you not to help your family. That's not what this is about. It's about how you do it. Maybe you pull the money from a Roth account instead, where withdrawals don't count against you. Maybe you spread the gift over 2 calendar years to soften the income hit. Maybe there are ways to give directly that sidestep the whole problem. The point is, generosity is beautiful, but generosity without a plan can cost you far more than you ever intended to give. And that brings us to number 5, the one that got Walter. The most common tax bomb of them all, and the one hiding in plain sight in more retirement plans than any other. It's this: treating all your money like it's the same money. Let me explain what I mean, because this is the big one. Most retirees have their savings spread across 3 very different kinds of accounts. And they don't realize these accounts are taxed in 3 completely different ways. You've got your traditional accounts, your regular IRA and 401k, where every dollar you pull out is fully taxable. You've got your Roth accounts, where qualified withdrawals are completely tax-free and don't even count toward that IRMAA calculation. And you've got your regular brokerage or savings, which sits somewhere in between. Now, here's the mistake 9 out of 10 people make. When they need money, they just pull it from wherever. Whatever's easiest, whatever has the biggest balance. They treat it all like it's one big pot. And that right there is how you accidentally set off every bomb we've talked about today. Walter's mistake was exactly this. When he needed extra cash a couple years back, he pulled it all out of his traditional IRA, the worst possible account, because that's where most of his money was and nobody had ever told him the order mattered. That fully taxable withdrawal spiked his income, and 2 years later, boom, there's the Medicare letter for $400 a month. Here's the counter move, and it's the most powerful idea in this entire video. The order you pull money out of your accounts matters just as much as how much you pull. Financial folks call it withdrawal sequencing. In simple terms, you draw from your different accounts in a deliberate order, blending taxable and tax-free withdrawals so that your total reported income stays low and controlled, deliberately kept under those tax and IRMAA thresholds. Done right, you can pull the exact same amount of money Walter did, live the exact same lifestyle, and never once trip a wire. Same spending, same life. Completely different tax bill. That's not a trick. That's just knowing which pocket to reach into. So let me leave you with this. Every one of these 5 bombs has the same thing in common. None of them go off because you were foolish. They go off because you did something that looked smart in isolation without seeing how it connected to everything else. The Roth conversion, the forced withdrawal, the home sale, the gift to family, the account you pulled from without thinking. Every single one felt responsible in the moment. The retirees who sail through this stuff aren't smarter than you, and they didn't save more than you. They just did one thing differently. They looked at the whole board before they moved a single piece. They knew where the tripwires were, and because they knew, they walked right past them. So before you make any big money move after 65, before you convert, before you withdraw, before you sell, before you give, I want you to stop and ask one simple question. What does this do to my income this year, and what will it do to my Medicare 2 years from now? That one question, asked at the right moment, is worth more than any tax return I've ever fixed after the fact. If this opened your eyes even a little, do me a favor and hit that subscribe button on your way out. Every single week, I break down another one of these quiet traps, the ones that cost good, hard-working retirees real money that nobody ever warned them about. I'm Calloway, and I thank you kindly for watching. Take care of yourselves out there.